The AI bubble is popping. Bitcoin is just chilling. And a massive rotation is happening right now in July 2026 that could reshape the entire market. Here's what you need to know. Just a few months ago, AI stocks were untouchable. Nvidia, Meta, Microsoft, all riding a wave of hype. But in July 2026, the narrative flipped. Hard. According to a Bank of America survey, more than half of fund managers now believe AI stocks are in bubble. But the revenue? Only about $60 billion. That's a gap of $340 billion. Financial analyst Hedgy Markets warned this could be uglier than the dot-com crash. Tether CEO Paolo Ardoino called an AI correction the biggest risk for Bitcoin in 2026. He warned that because Bitcoin is now tightly correlated with US equities, a spillover is almost inevitable. And in July 2026, that spillover started. AI stocks sold off hard, dragging tech indices down. But Bitcoin? It barely flinched. That's the story nobody's covering. Bitcoin did dip below $60,000 earlier in July, hitting a 21-month low near $58,000. That's a big deal psychologically. But it bounced back fast. By July 15th, BTC climbed back above $65,000. The recovery was driven by softer US inflation data and a sudden reversal in institutional ETF flows. But don't mistake that for a new bull run. The ETF outflows in June were record-breaking. $4.5 billion exited spot Bitcoin ETFs, beating the previous record of $3.56 billion from February 2025. That $4.5 billion came mostly from institutions, hedge funds, family offices. Not retail panic. That's important because institutional selling tends to be more persistent. So why is Bitcoin not crashing harder? Because there's a rotation happening. Capital left AI, but it hasn't gone back to crypto in a big way yet. It's sitting on the sidelines. Google search trends for Bitcoin and crypto terms have declined from their 2026 peaks. Retail FOMO isn't here. Without fresh retail money, crypto depends entirely on institutional flows, which are inconsistent. Meanwhile, the macro environment is brutal. The Fed, under new chair Kevin Warsh, has removed expectations for rate cuts in 2026. Sticky rates, a stronger dollar, geopolitical tensions, it's a perfect storm against risk assets. Arthur Hayes, former BitMEX CEO, argued that Bitcoin's next major bull run depends on fiat liquidity. He says capital may rotate back after the AI trade overheats and corrects. That could be the trigger. But here's the twist. Some analysts think the AI correction could actually hurt crypto first. Overstretched, debt-funded equity markets unwind fast, and Bitcoin's correlation with tech stocks means it gets dragged down. That's exactly what happened on July 17, 2026. Yet Bitcoin has shown remarkable resilience at the $60,000 level. Every dip below has been bought aggressively. That suggests there's genuine support, not just manipulation. The key question: can Bitcoin hold the high $50,000 to low $60,000 range? If it loses $58,000, the next stop could be $50,000 or lower. That would be a full-blown crash. But if it holds and ETF outflows stabilize, we could see a slow grind higher. The rotation out of AI might eventually find its way into crypto as the next speculative frontier. Ethereum is hovering near $1,750 to $1,800. Solana is in the high $70s. Altcoins are bleeding, but not as badly as you'd expect in a crash. That's another sign of consolidation, not panic. The SEC added 3 crypto rulemaking items to its 2026 agenda on July 7. And the UK's FCA published its final crypto framework on June 30. Regulation is moving forward, which could bring institutional clarity. But for now, the market is in a weird limbo. Not crashing, not rallying. Bitcoin is chilling. AI is crashing. The rotation is real, but it hasn't settled yet. What about the AI side? Forrester predicts a market correction in 2026. Many analysts think the AI hype cycle peaked in early 2026. The spending-to-revenue ratio is unsustainable. If the AI bubble truly bursts, it could trigger a broader risk-off move. Bitcoin might fall to $60,000 to $75,000 according to some models, but institutional support could limit the downside compared to past crashes.